Bonds or stocks? One stock or a bucket of stocks? While bonds may seem like the safer option, the stocks have the potential for high returns and long-term growth. In this video, we will go through the pros and cons of both options and share with you on why Warren Buffett thinks stocks are better than bonds when it comes to investments.
Between buying and holding a 30-year bond for 30 years or holding a basket of American stocks, there's just no question you're going to do better holding stocks.
For most investors, diversifying a portfolio with a combination of stocks and bonds is the best choice to achieve risk-mitigated investment strategy. One of the good options to consider is S&P 500. If you want to learn more on why Warren Buffett and Charlie Munger say S&P 500 is better for most investors, please refer to the time card attached and watch that video. Stocks and bonds are different. There are different types of investment that have their own benefits and drawbacks. They also have different ways of making money, and of course losing the money. Stocks are essentially the proof of ownership in a company. Now that give the investor an opportunity to participate in the company's growth. This investment carries the risk. You could earn a lot or you could lose everything you have. In some scenario, the stock may drop to zero. Here is a great example to understand the high risk, high reward scenario for a stock investment. Tattoo Chef, TTCF. It is a plant-based food company, produces and sells a portfolio of frozen food. The company was a very popular investment choice back in 2020 and 2021. The investor at the time believed that the Tattoo Chef was going to change the food industry, and the company was ready to make profits. Since the investor had faith on the bright future, they took the chance to ride with the company. The stock price went from $10 per share all the way to $20 per share at its peak. However, the stock price didn't stay that high. It continued fluctuated for a few months until it started to drop all the way to $1.30 today. So what changed? The harsh reality is, Tattoo Chef wasn't making any money at all, and it is still not making any money today. Investor is not stupid. They noticed the risk. The business didn't generate any positive cash flow and have little cash to burn. In the high interest environment, this kind of growth company faced a lot of headwind. Business performance poor, and TTCF stock price started to drop because the investors sold their shares. As you can see from the Q3 2021 to Q3 2022, the profit margin percentage had been decreasing. The net income was always minus, it is negative value. So why would you invest in a company like this then? What do you think on the investment of Tattoo Chef? The investment depends almost entirely on the hope of bright future. The future performance was accounted to the stock price already. When the company was not able to fulfill the expectations as a growth stock, the risk of not making a profit warned the investor and they decided to leave. Look at this chart. Walk right. Would you like to invest in a stock like this? Leave your comments below. Instead of having a roller coaster experience, you can consider a more secure investment, bond. A bond is like a loan that investors give to companies or governments. The company or government promises to pay back the loan with extra money, which is the interest in this case, on certain dates. These extra payments are called coupons. The date when the loan is paid back is called the maturity date. Companies, government, and municipality use bonds to get the money for different reasons, like funding for school projects, preparing welfare programs, etc. Some bonds can be more risky than the others, and the investor may lose their money if the company or government is not able to pay back the loan. In early 2014, Shanghai Chaori Solar Energy failed to make a $14.5 million payment because the company had been suffering from the overcapacity problems for some time. The local government and the cheap finance locally led to a group of firms entering to the market. It was very competitive for the company to survive. Since the company was not able to pay back the loan it took, the bond itself lost its value. This type of bonds are called high-yield, non-investment grade, speculative grade, or junk bonds. They are not considered as good investment. However, some people still invest in them because they offer higher returns. From this lesson alone, we know that there will be better pricing in the bond market where the good credit is priced higher and the bad credits are priced lower. After going through the pros and cons for both stocks and bonds, what do you think right now? Do you know what you want? You don't need to tell me the answer at this moment, just leave the comments below. Now let's hear what Warren Buffett has to say on stocks and bonds, hearing his perception.
If you tell me that 3% long bonds will prevail over the next 30 years, stocks are incredibly cheap.
Okay.
Because even, I mentioned that Kraft Heinz earns $6 billion on $7 billion of tangible assets. Even if you pay $70 billion and you earn $6 billion on it, that's better than having $70 billion out in 3% government. Interest rates govern everything. And if there were a way to short 30-year bonds and own the S&P for 30 years, I would give you enormous odds that the S&P is going to beat 30-year bonds. Now, we've had this period of extended long-term low rates, not only here, but around the world, and now it looks like we're not going to jack them up very fast. So we may be in a new world, the world that Japan entered back in 1990, and if so, stocks will, when we look back on it, will look very cheap. But, this has not been the history of the United States to have these continued low interest rates. So if I had a choice today for a 10-year purchase of a 10-year bond at whatever it is, or 10 years, or buying the S&P 500 and holding it for 10 years, I'd buy the S&P in a second.
Well, that brings us to a question that a viewer wrote in. This is T67. Piyush Pant says, from the annual report in the 13F, it looks like Berkshire was the least active in the public markets in the quarter when the stocks were the cheapest. You also did fewer buybacks in the fourth quarter when Berkshire was cheaper. Was taking the foot off the gas in the fourth quarter a conscious decision? And based on what you just said, we got all these signs that look like the Fed was not going to be raising rates in the fourth quarter too. So why wasn't that a buy signal for you?
Well, I thought stocks were a buy in the fourth quarter, just like they did in the third and second and first quarter. But sometimes we have other things in mind too that may use a lot of money, and sometimes they work out and sometimes they don't. But
what does that mean? You were holding your cash in case a deal came through?
We had at least one deal possibly that would have been very large, and so I liked stocks in the fourth quarter, but I would like buying a business even better.
Is that deal?
And incidentally, I did say in the annual report that we expect to be net buyers of stocks in this year. We have not been net buyers, I should point out. I mean, the market's gone pretty much straight up. I still think stocks are more attractive, but I have trouble buying it when every day it's up.
Warren Buffett, one of the most successful investors of all time, has stated in this interview that he believes the stock is better than bonds. The S&P 500 is actually a good choice for most investors. He also pointed out that the index has historically generated higher returns than bonds over time, and the stock market has always trended upward. If you like my video, please give me a like and subscribe. Enjoy, and I will see you next time.